The current state of the U.S. housing market is a complex web of influences, including high mortgage rates, inflation concerns, and Federal Reserve policies. This video will take you through what's going on in housing, why it's happening, and how it could impact buyers, sellers, and renters alike. We'll look at everything from how Treasury bond yields influence mortgage rates and real estate. To start with, we need to understand the connection between mortgage rates and Treasury bonds. Imagine a 10-year Treasury bond and a 30-year mortgage rate as cousins in the financial world. They're not directly tied, but they share similar traits, and they respond to the same types of risks and market conditions. Both involve long-term lending, and both are heavily influenced by inflation expectations. When inflation is expected to rise, investors seek higher yields to compensate for the potential loss in purchasing power over time. This leads Treasury yields to go up, and as Treasury yields increase, mortgage rates tend to follow, because lenders also want to be compensated for lending money over the long term in an inflationary environment. It's important to recognize that even though the Federal Reserve has the power to adjust short-term interest rates, it doesn't directly control long-term rates, like those for 30-year mortgages. Instead, those rates are shaped by the market's perceptions and reactions, particularly to inflation. The mortgage rate you see when shopping for a home is largely a reflection of these perceptions and the risk premiums investors demand to protect their investments. But what's driving this current high-rate environment is more than just inflation. There's a growing sentiment among investors that inflation will persist for longer than the Fed's current forecasts. The reasons for this outlook are tied to broader economic concerns, including government debt levels. The U.S. government's growing debt burden is raising questions about whether it will eventually have to make difficult choices that could impact inflation control. More debt can mean more money circulating in the economy, which often puts upward pressure on prices if economic growth doesn't keep up. This sentiment among investors that inflation will be here for a while means they're expecting higher mortgage rates to stay with us. And this becomes especially relevant for the housing market. Higher rates make it more difficult for buyers to afford homes, especially as the costs of borrowing have surged in recent years. People who may have been able to buy a house comfortably in a lower rate environment are now finding themselves priced out or pushed towards smaller properties or less desirable neighborhoods. This is already causing a slowdown in home sales and impacting the real estate market as a whole. If we look at home sales, there's already evidence that these higher rates are making a big difference. According to data from Zillow, home sales are only expected to grow by about 2% in the coming year. That's a pretty minor increase, considering the strong demand we've seen in the housing market over the past decade. Many potential buyers, especially first-time buyers, are now sitting on the sidelines, waiting to see if rates will come down or if new housing affordability policies will emerge after the upcoming presidential election. In a recent survey, nearly a quarter of potential first-time buyers said they're holding off until after the election, hoping for new initiatives to make buying a home more affordable. Some of these potential buyers are specifically interested in the housing affordability plans of political figures like Kamala Harris, while others are watching to see if Trump's policies could make a comeback. The uncertainty surrounding policy changes is creating a kind of stalemate in the housing market. Buyers are waiting for rates to drop, while sellers are holding out for better offers, hoping the market will turn in their favor. This waiting game has contributed to what many are now calling a neutral housing market, where there's inventory but fewer people are willing to make the move to buy or sell. At the same time, rent prices are showing signs of stabilizing, which is somewhat unusual given the rapid increases we've seen in recent years. Over the past month, rents have barely moved. For renters, this might feel like a relief, especially for those who've seen rents rise sharply in recent years. It's a signal that the market is cooling off, but it also reflects the broader picture of affordability challenges that people face across the housing spectrum. With more people opting to rent because of high mortgage rates, landlords were able to raise rents consistently over the past few years. But now, as renters hit their affordability limits, rent growth has started to slow. This stabilization in rent growth points to an overall trend where demand is steady, but there's a reluctance to pay ever-increasing prices, which signals that we may be seeing the beginnings of a broader market shift. People are waiting to see what happens with mortgage rates and home prices, and they're cautious about locking themselves into long-term leases at high prices. The slower rent growth could be a sign that the market is finally balancing, but the underlying affordability issues are far from resolved. Let's move on to the Federal Reserve and its recent decision to adjust interest rates. Recently, the Fed decided to cut rates by a modest 25 basis points. They did this in response to inflation finally showing signs of slowing down. One of the Fed's preferred measures of inflation, called the Personal Consumption Expenditures, PCE, price index, has dropped to around 2.1% year over year. This measure looks at what consumers are actually spending, and it's considered a leading indicator for inflation trends. When the PCE comes down, it's usually a good sign that inflation is cooling, and for the Fed, that signals they may be able to ease up on their rate hikes. However, this isn't the only factor guiding the Fed's decisions. They're also closely watching the job market, which has started to show signs of slowing down. In September, the US added only 12,000 jobs, which was much lower than expected. The unemployment rate is still low, but if job creation slows further, it could indicate a cooling economy. The Fed's mandate is to balance inflation and employment, so this job data is critical for their decision-making. A slowdown in hiring might mean that the Fed won't need to raise rates much further, but it also adds a layer of uncertainty to their strategy. As if all of these economic factors weren't enough, the upcoming presidential election is throwing another layer of complexity into the mix. Historically, election years create a lot of uncertainty in the economy, especially as investors and businesses wait to see who will be in charge and what policies they'll enact. When we look at past data, however, we find that the stock market itself doesn't actually see a significant difference in performance based on which party is in office. The average annual return under Republican presidents has been around 10.2%, while under Democrats, it's slightly lower at 9.4%. This means that while the market does see fluctuations, it generally adapts and moves forward, regardless of political party. Interestingly, though, Republicans have seen slightly higher returns but also more volatility, meaning that under their administrations, investors experienced more ups and downs in the market. While some investors may prefer this volatility, as it can create buying opportunities, others prefer the stability that often accompanies democratic administrations. This tells us that, for long-term investors, staying the course might be more beneficial than trying to time the market based on the outcome of an election. Finally, all of this leads to the question of long-term investment strategies. With so many unpredictable factors in play, from the Fed's decisions to election results, it's easy to feel overwhelmed. But what history has shown us is that taking a long-term approach to investing is often the most successful strategy. That means focusing on what you can control, like maintaining a steady income, living within your means, saving consistently, and investing in assets that have a track record of long-term growth. No matter what happens with the economy or interest rates in the short term, these principles will help you build financial stability. For most people, this approach means staying disciplined and not getting swayed by market noise. It's about putting your money into the market, whether it's through stocks, bonds, or real estate, and letting time do the work. The key is not to try to time the market, but to spend time in the market, allowing compound growth to work in your favor. So there you have it, a comprehensive look at the current state of the housing market, mortgage rates, Federal Reserve policy, and the economic factors that might impact your financial future. The housing market is in a challenging spot right now, but understanding the underlying forces at play can help you make more informed decisions. Whether you're a potential home buyer, a renter, or an investor, the best approach is to stay focused on the fundamentals. Thank you for watching, and be sure to like and subscribe for more content that helps you navigate today's economic landscape.